Hey guys, and welcome to another episode of Keepwize with Keepingly, and I am your host, Daniel Smith. Hope you guys had a great Thanksgiving and you were able to get some rest. Today I am missing my co-host Amir Ravna Bay, but hopefully she joins in at some point. Technical difficulties. So today we have a very important guest, as are all our guests, who we invite onto our podcast. But this one is really important because of some of the work that she's done. So today we have Nicole Bachaud from the Zillow Economic Research Team. And she uses data to tell people driven stories about the housing market, focusing on affordability, credit, and climate. Nicole previously worked as a consultant from Landesa, working in the Center for Women's Land Rights. And Nicole holds two bachelor's degrees in development economics and global development, and and has a micro masters in data economics and development policy. Wow, that was a mouthful. But welcome, Nicole, to the Keepingly podcast.
Thanks so much for having me, Daniel. I'm really excited to see where this conversation goes today. The work that you guys do is really great and super interesting, and I'm really excited to hear more about where your minds are at in terms of housing and real estate and homeownership and all these things.
Fantastic, and thank you for coming to our podcast and to talk about some of the work that you've done. So, Nicole, we met last week at a conference around housing, and you were one of the panelists on stage, and so you were speaking about climate and how climate impacts the home ownership journey and experience. And so one of the things that we like to do with Keeping is really kind of start with the backstory of the person who we interviewing. And so please tell us about like your backstory. What was it that led you to want to focus on issues in housing?
Yeah, I studied development economics in college, and so my background is more in the development space. But I think housing is a really interesting industry to work in because housing impacts everybody in one form or another, and it really is a fundamental part of the human experience. And so I think housing gives a lot of space to understand how people are interacting with their environment, how they're interacting with their finances, with so many different layers of the economy. So housing is a really exciting and interesting space to work in as an economist. Especially given my background in development, this is a space where I feel like there's a lot to be known. There's a lot of work to be done, and the research that I do is really people driven. Um, and that's what I've always been interested in, is in the kind of human experience of how we interact with the world around us. And at Zillow specifically, I'm able to have a ton of world-class data that I can use to really understand a lot of the challenges and the hurdles that people are facing in the housing journey. Looking at everything from becoming a renter to selling a home. And I'm really able to interact with a lot of different aspects of people's experiences and journeys throughout that process by really focusing in on housing economics and the data then resources that I have at Zillow.
Thank you very much for your answer. It really does provide a great insight into what you are doing and how that really impacts the whole home ownership ecosystem. And home ownership isn't just the point where you get into the home, but the planning, how to go about that journey. A lot of the things that you mentioned in that um, brief introduction, in terms of what you do. So tell us, when you decided to get into development economics and starting in housing and data, you see, what I would say inspire that moment because there's so many different parts of development economics. What specifically around housing, beyond the things that you found or have found since you started, what really nailed it for you and say, okay, I want to study housing as my core area for what I do as a living?
Yeah, so before joining Zillow, I worked for a nonprofit called Landesa that focuses on land rights. So that was kind of my pseudo introduction to housing, was through property rights and land rights, and just really understanding how fundamental having a place to call home is, and being secure in knowing that that place is not going anywhere. How that really impacts every other aspect of your life. Once you have that base of home, that's when other things begin to matter more and take shape. So, that's where I kind of was introduced to um, the housing economics in itself, but really just this idea of like having security in where you live gives you the foundation to thrive in other aspects of your life. And so, housing in the United States is a super interesting and diverse industry and topic to research. We have growing homelessness problems across many cities in this country at the same time that we have, some of the highest home prices anywhere in the world, probably. So there's such a dichotomy of, who is interacting and how people interact with housing, that I think it just gives for a lot of really interesting spaces to understand, how government policy can interact with, the way that we approach our homes and how we buy, sell, or rent, as well as just the tech companies that we're seeing pop up that providing tech-based solutions and products to really enable people and empower people to make those decisions on their own. I think it's just really encouraging to see. It's exciting to be a part of, and so that's really what's kind of led me to where I'm at right now.
Oh, fantastic. And so, in some of these, one of the things that we spoke about last week was really about your whole climate experience, or how housing is impacted by climate. And so that is one of the things that you, I presume, have interest in. But also you've done studies at Zillow that is focused on like the disparity in housing based on race. And you've done a few other studies. So please tell us, in terms of what studies have you done, and then which of these studies intrigued you the most, or actually the results coming out of the study, which one like intrigued you the most to kind of continue down the rabbit hole? And what was your most interesting finding from all of the studies that you've done thus far?
Yeah, I'd say recently, so a big theme in a lot of the research that I've done at Zillow has been around credit, the credit industry, access to credit, how people interact with credit, because that's a really big foundation for homeownership specifically. For being able to purchase a home, you have to be able to access credit, or you need a lot of cash, to avoid getting a mortgage. So understanding the landscape of it has been super integral to a lot of the research that I've done. Recently, I put out some research that looked at where people are able to access credit easily or with a lot of difficulty. So the New York Fed puts out this index all the way down to the census tract level that helps you understand, what communities are able to access credit and what communities are not able to access credit. When looking at this data on a map, at the MSA level, so the metropolitan level, we can see there are a lot of clusters in most metros across the country where it's really difficult to access credit for people who live in those areas. When you overlay that with maps that look at homeownership rate, you see that homeownership rate is a lot lower in those places where it's hard to access credit, which makes sense. If people don't have access to, walk into a bank, say, they would have a lot of difficulty being able to find financing for a mortgage. So homeownership rates are lower in these places. You also see, when you layer that on top of race maps, that in those pockets where it's difficult to access credit, those are places where you see the majority of population being Black. And this is true across many markets across the country, all the way West Coast, East Coast, South, Southwest, Midwest. These trends kind of follow the same pattern in many metros. I think the most interesting part of that is, looking at the current climate of the housing market right now, where mortgage rates are extremely high. Yes, they're coming down a little bit, but they're still very, very high to what they've been in the past several years, in the past couple of decades even. We see the cost of a mortgage being really, really expensive. If you can afford to pay for a mortgage, in this environment, that's a pretty big deal. So we have mortgages really expensive, and that's making the trade-off between buying a home and renting a home look different than it's been in the past. So in the majority of the United States right now, it is cheaper to rent than to pay for a mortgage on the same house. So we see the kind of shift towards renting and being a lot stronger right now because that mortgage is so expensive. But we go back to these credit maps where it's hard to access credit, where it's difficult to get homeownership, so homeownership rates lower in places that are predominantly Black. Those are the areas where it is still cheaper to pay for a mortgage than to pay for rent on the same house. So where people are not able to access homeownership is where they still see financial benefits, even in this most challenging housing market that we've seen affordability-wise in decades. That's where we have those affordability pockets for homeownership, is places where people are not able to access it. So that was a really, I think, interesting finding from the research that I've done, in the past couple of months, is just understanding the challenge that folks are facing, saying, I pay more money to rent my house than I would pay to buy it, but I'm not able to access the buying part. I'm not able to access that financing. And the why this exists goes back to redlining. These are communities that were underserved by financial institutions that people were forcibly moved into. And you're seeing still those places are underserved by banks and other traditional financial institutions. And so credit and financing are still at risk and really hard to access in these places, decades later. And so, that's one of the big findings that I've seen, out right now in this market, is it's really tough to get ahead when, you have all the means, you're paying the money already to rent these homes, and accessing the financing piece is just falling short because of the policies and the way that we have, structured the credit industry in housing and finance.
Wow. You said a mouthful. And my mind is spinning with tons of questions that can break this to break out of what you've just said. But I'll start with the top part of it, the top layer, which is really the credit piece. And so ultimately, part of home ownership, to be able to qualify for a mortgage, we need to know your credit score, you need to have a credit history, things like alternative forms of being able to show income, proof of income and stuff like that, especially in minority communities, sometimes less available, but also less accepted. So whether you are able to, go through a Fiverr or, some other platform, if you're doing DoorDash or something, which gives you additional credit, it may not necessarily show up on an income statement. Mm-hmm. And so thus those things may leave some communities out. So in terms of what you've been able to see from your on top of the credit piece, what do you think is an opportunity for us to be able to change the system, to be able to create more avenues for these potential homeowners who may be credit insufficient based on what their income shows, but do have the means to actually pay the rent each month, which is actually higher than the actual cost of ownership in some places?
Mm-hmm. Yeah, I think this kind of goes back to the structure of the credit scoring system. credit scores were introduced after redlining was outlawed. So, sometime in the 80s is when credit scores really took place as this is how we're going to deem people worthy of getting access to a mortgage, is by this algorithm that's, using numbers only. It doesn't take any personal information from the individual. Nothing about race or sex is put into this credit score, so it should be far less biased. But you look at going back to what happened during redlining when we had communities that were forcibly moved into places that did not have access to financing. You had entire generations that had the opportunity of homeownership taken away from them. So the opportunity to build equity, to gain household wealth, those things were removed from a full generation. And then you come in and later say, okay, let's start basing things on credit, right? You have a lot of folks who didn't have the means to be able to pay for a down payment since their equity had been taken away from them with the removal from their homes. You have also people who don't have access to banks to be able to open lines of credit easily. And so the ability to open and maintain credit and be able to get loans without capital and without that ease of accessing finance has led to these communities still having lower credit scores now, because they're still left with kind of the historical leftovers of what's happened decades in the past. So, when we look at how do we fix the problem now, how do we look at the communities who are trying to get into homeownership, who maybe have the means to, but just can't get through the red tape of being able to actually qualify. What we need to do is look at, okay, so this credit scoring system that was created wasn't created in an equitable way that, was able to provide opportunities to people who had been marginalized by the system before. And so we're just seeing the same people be left out. So when we look at what do we do moving forward, we have to systematically overhaul the credit system as we know it. In my opinion, start from scratch, right? But that's really hard to do. So what we're seeing now is things like allowing for rent payments to be considered part of a credit scoring model. So if somebody's been paying their rent on time for years and years and years, that should benefit their credit score. In the past, it hasn't done anything for your credit score, but now we're starting to see more places accept those this positive rent payment history as a basis for allowing for credit scoring to happen. So things like that can really help to level the playing field for folks who haven't had access in the past. But, I think they don't necessarily go far enough. And not all credit scoring models will accept those payments as part of their basis for giving a score. And so the system is still very unequal in terms of how we're being able to deploy these programs as they're kind of being evolved throughout different policymakers.
Yeah, and as you were speaking, one of the things that I started thinking of was the fact that even as a homeowner, when you pay stuff, your mortgage payments or even utility bills, etc., they don't necessarily count towards your credit score. And for some people, they say, well, ultimately you have a house already, so it doesn't necessarily matter. But the question really starts becoming, well, if I want to buy a new house or, since I'm paying the bill anyway, it should, count towards. And so, as you were speaking about evolving the model of how credit is actually looked at, I think that straight across the board, not only for those who want to buy a house, but even for those who are in a house, ultimately it may not necessarily push up your score that much, but ultimately it's just really providing and tracking of that history. I think that there's so many opportunities for us to overhaul the system to make it more equitable. And so I think that ultimately that's kind of what you've been seeing in your studies. But moving, I would say, onto the next layer of that conversation after the credit part of it.
Well, if I could add really quickly on this idea of people who already own their home, I think we're seeing a lot right now of this kind of narrative of marry the house, date the rate. You can just refinance later, right? If you just get into the home, get through the next few months, and then you can refinance. refinancing is not free and it's not open to everybody. You have to still maintain that credit score. You have to maintain your income. You have to maintain your cash reserves to be able to qualify to refinance. So I think that's a hugely important thing that people going into homeownership right now should be thinking about is, am I going to be able to kind of play this game again when I go to refinance, if that is my strategy or my plan? I think that's super important to be thinking about.
Man, Nicole, you're just dropping bombs on me. I'm just like, as you say that, another bomb went off in my mind, and it's basically because ultimately I think that, and I think we briefly touched on this last week when we spoke, but ultimately the whole conversation of who refied when we were historical rates in 20 and 21,
Yeah.
and saying that like $56 billion in refis were done, but only 3% of minority populations decided to refi or were qualified or able to refi during those historical rates. So we have tons of people who missed out during those historical rates. And therein lies a problem in terms of the education that people actually have around the refi. So while it's, I think, a real cool thing to say, marry the house and date the rate, the fact is that, as you rightly pointed out, sometimes you don't have the number one, the education, number two, the same financial position to date the rate, because you have an emergency, somebody gets sick, you decide to go do something new on your house, all of a sudden your credit score shifts and changes, and you are not able to qualify for that. So I think that, ultimately this whole conversation about marrying the house and dating the rate, it works for communities who have better outcomes and who have better options. But if you don't have those outcomes, and so I guess, let's kind of dive into that though, in terms of what you see from and you did the whole study on equity in housing, or the race equity bit of housing, what have you seen from that? Because there are persons who would try to tell us that, hey, there isn't necessarily a disparity in housing rates based on race and stuff like that. And what have you found, and what do you think about such arguments?
Yeah. So the research that I put out recently on racial disparities in housing really highlight the different challenges that certain races face when approaching housing, when maintaining housing. I'll start with something like a down payment. So when you look at the ability to come up with this large sum of money, which is a really large sum of money given how high home prices are right now, we see a lot of disparities in terms of where people are getting their down payment from. We see certain groups that are much more likely to receive a down payment from friends and family, whereas for Black mortgage applicants, only about a third, just over a third of mortgage applicants that are Black are getting that down payment from friends and family, versus over 45 and 50% of white and Hispanic buyers who are getting that down payment from friends and family. So there's a disparity of who is able to access that funds from their network that really limits, people's ability to kind of enter the playing field of getting into homeownership. Then you look at how much that down payment is for the typical purchase. Asian and white borrowers are putting down 20%, but Black borrowers are only putting down 5% of the home value as a down payment. So the loan to value ratio is much higher. Your interest rate is going to be higher. Your loan balance and mortgage payment are going to be higher if you're putting down a low down payment. So that's a big disparity that we see. Especially when we're looking at for Black homeowners and Black mortgage buyers, is that they're much more likely to be getting like an FHA loan, so something that has a lower down payment threshold, which is helpful if you don't have a ton of money up front. I think a lot of people don't know you don't need 20% down to buy a house. You can put down much less than that. And so utilizing federal programs that allow for lower down payments is a helpful way to get over that huge burden of having this lump sum up front if you don't have the network to be able to kind of fundraise that amount of money. So that's definitely something that we see. and why, again, government programs and policies are really important for helping to level the playing field. Because if FHA loans didn't exist, you would see far fewer Black homeowners being able to access homeownership because of this down payment threshold. So that's one place that we see a lot of disparities. When we look at, okay, so I have the money ready to go, I'm ready to go make a purchase. Mortgage denials are another big piece of the puzzle, where we see a lot of discrepancy is how people are interacting with lenders. And the number one reason why we see people getting denied for a mortgage is either based on credit or debt to income and history. So really that financial aspect is so important for being able to see equitable outcomes. And we're not in a place where we're seeing equity in that right now.
Boy. Nicole, when you think about it, I think that you've just basically analyzed and summed up, a lot of what we see in terms of the historical nature of the market and where we are. So, you know, the questions, and I think that you alluded to it before in terms of summer overhaul of the system, but based on your research and some of the things that you see, do you think that there are, I would say, easier ways for us to be able to correct some of the historical wrongs of the past and to be able to provide, more equitable outcomes for, especially for these communities that don't necessarily have the quote unquote traditional financial incentives, whether or not it's money down, because we and I know last week we heard about the different banks that had special purpose credit programs, and they've done that. So in addition to reduce money down options, there are options and incentives that are in the market, especially to be able to help. But what do you think, coming out of some of the things that you've seen in your research, is possibly the way to be able to create better solutions and better outcomes for these communities? Because when we look at numbers, around home ownership rates for the Black community, it's still at 43 to 45%. Latinos are about at 50%. Asians are higher, and then the white population, etc. So, what do you think? Based on what you've seen, we can do to basically create create solutions to help better impact and outcomes for these communities.
Yeah, I think the first thing that we need to be thinking about is using a data-driven approach. There's a lot of good intentioned ideas that float around, but those don't necessarily have the intended impact when they're actually deployed. So something like down payment assistance. Down payment assistance is super helpful, and you can see certain communities where having access to more down payment funds would be absolutely imperative to them being able to access homeownership, jump over that hurdle, and get a lower rate with a higher down payment, be able to afford closing costs, be able to pay down other debts. But just blanket offering people, everybody out there gets, down payment funds is a policy that was suggested a couple of years ago, but it wouldn't necessarily impact the populations who, have been marginalized in the past. People who, when you look at incomes of renters who could pay for the typical mortgage on a home, and you just gave all of those people money to go and put down on a home and purchase a home, you'd see that the majority of those folks are going to be white. And so when you're looking at, okay, how do we help, marginalized folks, Black and brown communities who have been left out of housing, you have to be intentional about that upfront in developing these policies. So instead of let's just give more access to funding for down payments, let's give access to funding in specific communities to borrowers with specific incomes, and be really intentional about who you're targeting there. What we found through our previous research when we looked at this specific question was paying down people's debts actually would have a bigger impact on Black and brown populations than giving cash for a down payment. Debt to income ratio is another huge reason why people are denied mortgages. So being able to pay down debts and reduce that burden would give people access to lower interest rates, would free up their money to be able to be used for other things and paying off those pre-existing debts. So I think more creative solutions that are really data driven and understand the actual financial landscape of the communities that you're trying to impact is hugely important. So that's something that our research previously shown would be more impactful. And I think that should be the approach to really any of these questions is, let's go look at the numbers. I say that as an economist. I know a lot of policymakers maybe don't share that same love for being in the weeds with things, but I think that's, where we're at with what we need to be doing is be really, really intentional about who we're helping and how we're able to do that.
I think that is 100% accurate and ultimately where we need to be, because we have, and so not despite the fact that Nicole is somebody who has a master's that is data driven and focused, right? But ultimately, I think that data has to be the way in terms of the way we look at solutions. But I also think that data allows us to be able to create better outcomes and solutions that provide equity rather than, what we've historically done. And so I do think, and I agree with you 100%, I think that data-driven solutions are where we need to be going. But, for historically marginalized communities, I think that it's important that we have some type of resetting of the playing field to be able to ensure that the data isn't skewed, because, if we put data on top of historically skewed solutions, we're going to see skewed results in terms of one way that may not necessarily drive. So I think that it is also helpful to put that in there, where we are focused on these solutions that create value, and also how do we level up these communities. But one of the things that you mentioned was in terms of denial rates. I think that was the third layer in terms of what you have really started mentioning, and in terms of denial rates. And what do denial rates look like for some of these historically marginalized communities?
Yeah, so what we see is, for people who are applying for mortgages, in 2022, which is the most recent data that I have access to from the Home Mortgage Disclosure Act, we see that Black mortgage applicants for primary homes using a conventional mortgage are denied at a rate of 21.6%. So 21.6% of Black mortgage applicants for your quote unquote regular home loan are denied. That's compared to only 8.8% of white applicants for the same type of mortgage. So the discrepancy in who is being approved is incredibly wide, and is actually increasing over the past couple of years, that gap there. So, being able to access a loan is really challenging, and what we're seeing is, by and large, the majority, of these times, it's just this person didn't have a good credit history. They don't have a high enough credit score. They don't have any credit. Their debt to income ratio is too high. So there's so many reasons to be kind of filtered out of the system through the checks that we have in place. Even if somebody has been paying that same or more money in rent for years, every single month, that the way that we're valuing people's worthiness to get into a home loan is not a very equitable environment for people who have been marginalized and who have been kind of left in the dust of a lot of the policies that we've seen. So I'd say this field of mortgage denials is really deep. There are a lot of disparities that exist within it. And it's definitely not really getting better. And so we need to go back and understand, why are we basing these decisions off of these really archaic systems? Can these systems be better? Do these systems need to exist at all? At this conference that Daniel's mentioned that we were at last week, a solution was thrown out that maybe we just look at people's income statements and their bank account statements and see how are you spending money and what does your bank look like at the end of every month. That can help us understand whether or not you're a credit-worthy buyer, maybe in a better way than these scores and kind of systems that we use right now. So maybe there's a different way that we can approach valuing people's financial worthiness than these systems that don't seem to be very unbiased and equal.
Yeah, I think I heard that last week as well. And I don't know that that solution flies. Uh, and it's just because, so over the summer, I was a part of the FHFA's fintech conference where, they got a lot of us in the same room. And when you realize, mortgage bankers tend to think in very different ways from
Mhm.
the rest of people in the housing ecosystem. And so, some of it will be making a lot of them comfortable and wrapping their minds around some of these proposed solutions. And I think that some of that really is going to be legislation driven and mandate driven, where ultimately either Department of Housing or FHFE says, hey, we're going to revise the rules around what is required for income, or what we look at or we take into consideration for income. But I think that that is going to upset, the traditionalists in the system who believe that the system is working fine for those who it serves. So I think that that is gonna become a lot more polarizing to some. For those of us who may be looking at it in a more progressive manner, I think that that solution obviously can work. But I would say the proof would be in how it's created and
Mhm.
what are the outcomes that we're looking for. So are we looking for increased home ownership? Are we looking for increased understanding the amount of income that people have so that we can now put them into better solutions, i.e., how much house can they actually afford? So I think that that would be what it comes down to in some of those instances. But I'd love to test. But you guys, so kind of going on that, you guys at Zillow developed your own solution. I think that it was a 1% down,
Mhm.
that homeowners or potential home buyers can basically tap into.
Mhm.
And I think that when I looked at that and I saw that data coming out, I'm like, here is a solution that is coming out and that is targeting a specific market segment. And the question is, do you think that we need more solutions like that? And I'm sure you haven't gotten to study that data as yet because it's still pretty new. But ultimately, do we need more solutions like that? And how do we align that with those who would say, well, that there is the potential of that toppling the market or creating scenarios like we saw previously in 2008?
Yeah, so, I think tech companies are at the forefront of changing the housing industry dramatically from what it looks like now and what it is going to look like in 20 years from now. Um, and I think there's a lot of room for solutions to kind of be brought up, different types of mortgage products, just the way generally we interact with housing. I think there's a lot of room for that to change. So how do I think that these types of programs will kind of land? I think we really need to focus on increasing financial literacy, of having people understand the really complicated and complex um, landscape of housing finance. I'm a real estate expert, quote unquote, but mortgages are really confusing even to me. So, increasing financial literacy and having things be able to be digestible for folks, I think is extremely important for making sure that people know what options are available, what resources they have access to, so that they can make an informed decision. Um, that's what loan officers should be doing, right? When you're going to get a mortgage, is those folks should really be walking you through all of the available products that you have and ways that you can, maybe get a 5/1 arm, and maybe that's an opportunity for you to have a lower interest rate for the next 5 years if you're planning on staying in the home short term, maybe looking at getting a longer or shorter term mortgage depending on your needs. So, I think there are a lot of products that already exist. I think there is room for new products to emerge, but financial literacy, I think, is going to be a huge part of the adoption of that. Being able to land in a sustainable way of just making sure that consumers understand what they're signing up for. I think a lot of regulations now are far better at that than in the past. And I think generally speaking, people, are better informed than they were, 10, 20 years ago, and the types of mortgages that they're getting into. But, I think that's definitely a space that we need to flush out more.
Oh, fantastic. And I guess, as you've mentioned it, that is exactly what we focused on with what we're building with our product at Keepwize. And I would say that, ultimately I have kind of landed on the same conclusion that you've landed on in terms of creating better solutions with the products that we have. And it does really revolve around literacy, because I think that, the process of getting a mortgage is hard. And we've defined that. Understanding what you need to be thinking of is also hard. So, a lot of people didn't refi because they didn't understand what to do. They didn't know. They didn't. I've heard persons say, "Hey, I had a mortgage at whatever percent," and I'm like, I didn't want to touch it because I didn't know what I'd go through, and I was comfortable with where I am, and I'm like, well, there was a possibility of you saving hundreds of dollars a month, and they're like, no, I was, satisfied. But then, one of the things that even I have realized coming out is that because there's such a fear of financial stuff sometimes, that people don't necessarily take the risk. There is the stat that says that 75% of home buyers accept the first product or first offering that they're given. So people sometimes don't even shop around because some people are so happy to get a yes that they don't even think, okay, well, maybe I should be thinking of what my other options are like, so I can possibly pay less. So I think that, 100% on that financial education and literacy piece. And as we get ready to wind up, one of the last questions, I have for you in terms of, so I know that you've done a lot of research and, that you've done a lot of things. As a homeowner yourself, how easy, so we've passed the point of, the mortgage part and, getting into the home. As a homeowner, how easy is it once you get in the home? Is it any easier, or is it just as difficult once you get into the home?
No, it is not easier once you get into your home. At the conference we were at last week, a couple of FHA folks and other folks out there were spreading around saying, oh, 203K loans are going to be a solution that can really help people get into homeownership, which for those of you who don't know what that is, that's a renovation loan. So if you're trying to renovate an older property, you can get a loan for the full value, including the cost of the renovation. That way you can kind of finance that part up front. I currently have one of those loans, and it was a complete nightmare. Even as somebody who, kind of knows what I'm talking about in this space, I could not get a straight answer out of anybody, and it took me months to finally get, figured out on what I was supposed to be looking at, and then the ways I was supposed to be approaching this loan. So, getting into homeownership is so hard. And then once you're there, it's the story doesn't end. And I think that's where a lot of, data companies and policymakers kind of turn around and start focusing on something else once somebody's in a home. But being able to maintain homeownership is extremely difficult. It's expensive. First of all, you have a pipe burst or your water heater goes out. Those are really expensive costs. So you need to make sure that homeowners have enough funds to be able to cover those things as they arise, that, renters don't necessarily have those same types of costs and challenges. So, just the maintenance costs on their own can be really large, especially depending on what market you're in. But I think the biggest challenge we're seeing right now for maintaining homeownership is in terms of property taxes and insurance payments. So home insurance and property taxes have increased incredibly over the last couple of years. you're looking at property taxes, increasing 30, 40, 50% for a lot of folks who had locked into their 30-year mortgage thinking, I'm set, this is my payment, I'm comfortable with it. All of a sudden, they're seeing those additional payments rising at really rapid rates. And for folks whose incomes have not been able to keep up, especially for older homeowners who don't necessarily have income growth in the same way that the working age population does, it can be really challenging to absorb these growing costs. So maintaining homeownership is extremely difficult, and something that we need to be focusing more on right now is being able to say, how do we help people who maybe have a lot of equity in their home, but are being forced to sell because they can't maintain the monthly payments that have been increasing? How do we create a solution? And probably from where I'm sitting, I'm seeing it as probably a more tech-driven solution for products that are going to be able to help those people maintain their ability to stay in their home if that's what they want to do. So I think that's the biggest issue I'm seeing right now.
Wow, thank you very much, Nicole. And you've just brought a really huge smile to my face. And I'm not sure if, oh yes, you were a part of that conversation about home ownership sustainability last week. But I
Yeah.
think that ultimately, I think that that's where, we see it is one of those big costs, and we don't have enough conversations about this, which is kind of why we started this podcast, because we want to get into those conversations and really give homeowners a realistic view. But I think that it is absolutely going to be wild. I mean, I live in Florida, part of this conversation. You've seen 14 insurance companies pull out in the last 2 years. And so what does that mean for the market? How much premiums increasing by year on year. And so this used to be the sunshine state where a lot of people would think about retiring. I'm seeing some kind of reversals in that people are actually selling out. And, I have some neighbors down the street, I think that their house is for sale. And so ultimately they're older persons. And so I think, well, maybe they're like, well, the cost of, insurance and property taxes may be too much,
Yeah.
Let's kind of take a different route. And so I think that is going to be, and we're going to have to get to solutions to those things rather quickly if we want to maintain the conversation that we have had as a society, where we tell people, hey, home ownership is a part of generational wealth. That may be, changing. We may have to start thinking about how do we create products to keep that true, because in some cases, it may be the part to some kind of financial ruin if you don't understand what you need to be doing.
Yeah.
Because property costs, the cost of just maintenance is rising, and then you have all these other costs that are stacked or are being stacked on top of it. And so, Nicole, we have to have you back. Hopefully we get Amira to join us in the next conversation. But this has been fantastically insightful. Thank you very much for your time and, your expertise and sharing your expertise with us.
Yeah, thank you so much for having me, Daniel. And yes, let me back anytime. I can talk about this stuff all day. So appreciate the platform.
Thank you very much. And, bye, folks. Thanks.
Thanks.